appreciation of what the REITs are and also the benefits that the investment vehicle presents to our industry. So we are really excited and highly appreciated to the Zimbabwe Stock Exchange and the whole team, at the Zimbabwe Stock Exchange for taking the time to organize this event, including identifying and also securing the appropriate presenters. And so let me also take this opportunity to acknowledge the presenters. And this is not in any particular order. Mr. Mike Juru, Mr. Welcome Mavingire, and Mr. Langton Nyatsanza. Gentlemen, the Commission highly appreciates your positive response to the call. We do not doubt that our trustees and officers of various pension funds attending this training will benefit tremendously as you share your expertise on the REITs and how they as an industry can participate in such investments and also reap the benefits that it presents. Lastly, I also want to acknowledge the board chairs, board members, and trustees of various funds, the principal officers and all other officers. Ladies and gentlemen, the objective of the training is to unpack these calls so that at the end of the training, we are all better able to understand the following key issues: what REITs are, and why, as an industry, we should be paying attention to this emerging investment class, the different types of REITs, and how they can be established, how to list the REITs on the Zimbabwe Stock Exchange, and lastly, the roles that sponsors play. And we'll also have one of our own pension funds, the National Railways of Zimbabwe Contributory Pension Fund, to share their first-hand experience in their journey to establish a real estate investment trust. As an industry that is heavily invested in properties, with close to 31% now, of our assets invested in properties as at 31 December 2021, the Commission acknowledges the role that REITs will play in unlocking liquidity in this highly liquid asset. Investment in property has always been, and it continues to be preferred by pension funds, given the long-term nature of retirement funds and the thrust towards value preservation, especially in a hyperinflationary environment. And therefore, I would like to urge all the trustees here present to pay close attention as our presenters unpack the REIT, so that at the conclusion of the training, we are able to understand REITs and also make informed investment decisions. The trustees here present have been specifically singled out and invited to attend this workshop owing to the high levels of exposure in property by the funds that they superintend over. And as previously stated, while we acknowledge the value-preserving nature of these assets, we also need to be cognizant of the fact that settlement of benefits and other obligations of the funds need liquid assets. And this is where the Commission is seeing the value of REITs. Hence this call for you, ladies and gentlemen, to start paying greater on REITs. We at this workshop will awaken that interest as it equips you with a better understanding of these investments. I want to thank you all for your time. I particularly want to thank you for joining this call, albeit the changes in the format of the workshop, and wish you a fruitful workshop. I thank you. Back to you, Director of Ceremony.
Thank you very much, Commissioner, for your opening remarks. On that note, I will now proceed to our first presenter on why REITs. This is important. It helps us have a better appreciation of why the industry should consider investing in REITs. To take us through that presentation is the Zimbabwe Stock Exchange. Anymore? If you are ready, you can take it over.
Thank you, Director of Ceremonies, and thank you, Commissioner Muradzikwa, for the warm welcome. We do appreciate the opportunity to talk to your constituents Thank you so much. I'll share my screen and hope that you can all follow through from the presentation. Director of Ceremonies, if you can confirm that my presentation is now on screen.
Confirmed.
Okay, thank you. So as indicated, let me also welcome all the participants to this session. I think the Commissioner has highlighted the objectives of this workshop is particularly to share insights on this new, not so new global-wise, but relatively new in the context of the Zimbabwean market, this new product called REITs. It has been in existence, I think, for more than 60 years now in other markets, but I think in our context, it's something that we are trying to actually get going. So in terms of my presentation, I'll just briefly touch about ZSC and probably our interest in REITs, touch briefly on what is a REIT, just the basics, where we are in terms of REITs in the context of our market, also touch on the listing process, why we think REITs something for the industry to consider, and lastly, just small incentives that we have for those that would want to list the REITs on the market. So to start, I think you are all familiar with the stock exchange. We are a licensed securities exchange, and our vision is to be the preferred securities exchange in Africa. And obviously, in pursuit of this objective, we intend to be the best in providing markets that facilitate capital raising, that enable people to invest, to manage risks, as well as offer a price discovery platform for businesses, government, and the public. And whilst we have been relatively successful in terms of the equity and ETF markets, I think when we started back then in the 1890s, it was predominantly equities and government bonds. Over the years, we lost the fixed income market, I think around 1999 going forward, when inflation became an issue. The fixed income market went off, and we then remained with equities. Late 2020, we then did the first ETF on the market, and we have seen some bit of interest on that market, but we think there's still scope to actually broaden the securities that we have in the market. And to us, we think getting more of real estate assets on the market is a way of actually diversifying the product offerings that we can offer on the market. We'll move on then to what is a REIT. It's a question that we just need to deal with from the onset. So I will start with the background. So REITs originated in the USA, the United States of America, and it was legalized through the enactment of a Real Estate Investment Trust Act in 1960, which authorized a real estate ownership structure with tax treatment similar to that of a trust, and facilitated a tax-exempt pass-through entity, which also allowed broad-based ownership and distribution of earnings to investors. So I think the key ways to grasp from what a REIT is that the objective or the rationale behind the enactment of the act in the USA was basically to get a structure where multiple ownership of a single building would be permissible, and that the tax treatment of that ownership would mimic direct ownership of that asset, So the vehicle itself, which will be owning the properties, would be tax exempt, or what we call a pass-through entity. And that this entity will then be required to distribute most of its earnings and capital gains to the investors. So in essence, we are simply saying currently, if you look at, if I may give an example of home ownership, if I'm a homeowner or a landlord, I own the house that I stay in, and if there's some space which I can lease, I'm renting it out, let's say a room, to a tenant. As the landlord, I then get all the rentals from my tenants directly. And currently, I think because we don't have like direct tax declarations, you actually maintain or you keep 100% of your rental as income. Then you move on to ownership, where you have got companies that can own a same building. The company owns the building, they collect the rentals, but then they are taxed on the income or on the rental which they earn. And that sort of ownership was deemed to be inefficient for individual investors because of the taxation that happens at corporate level. So to try and replicate direct ownership of buildings, REITs were then formulated. So the structure was that the entity would not be taxed, it would be tax exempt, so that the income which is earned at entity level just flows 100% to the investors, more like replicating your direct ownership of a house. Although you are not owning that.
Anymore?
Yes, sir. Yes, sir.
There is a concern that some attendees are getting feedback from your end. Possibly, if you could try address that from your end. I think from where you are presenting from, sometimes there is sound that comes from the background. Thank you.
Apologies for that. Let me just check it. All right, I was just talking to colleagues around me to minimize the noise. I'll go back to my presentation. All right, I was just trying to explain what a REIT is. Let me move on. So the REIT structure, like I was explaining, was initially designed to permit small and medium-sized investors access to your commercial real estate assets, and thereby providing a means to achieve benefits that are associated with direct real estate ownership for investors who previously could not directly invest in such assets. It will become clearer, I think, as we move forward, what it is. Just to give you a picture of what other jurisdictions. So it's not all countries that have got this framework for REITs. In Africa, we are basically talking of about 6 countries now, and probably 7 now that Zim is now in the picture. That have got REITs. The most successful market, obviously, being South Africa. They are very prominent with at least 33 REITs, which are also listed on the Johannesburg Stock Exchange. Moving on to REITs in Zim. So if you follow from the definition that this is really a legally permitted structure to allow, a tax pass-through entity to hold ownership of real estate assets on behalf of investors, and to also allow that entity to distribute a significant portion of the income to these investors. It means that for REITs to be established, there have to be some legal provisions that provide for that. So in our context, we've got the Finance Act number 2 of 2020, which provides for the tax exemption on REITs. It's quite detailed on who qualifies and how we can qualify to get that exemption. Then we've got the Collective Investment Schemes Act. It has got SI 172 of 1998, which provides for the mechanisms by which you actually establish the REIT, because the REIT in our context is a collective investment scheme. That's what the Finance Act says. It says you have to register a trust, and trusts as a collective investment scheme. It means then you are also governed by the Collective Investment Schemes Act and those two SIs. So the SI 240 of 2019 is the one that added REITs to the permissible schemes. Previously, it just talked of, you know, your schemes in equities or your schemes in money market, but it did not have specific provisions for schemes in property. So there was an amendment that was done in 2019 to add REITs to the basket of schemes that can be registered under the Collective Investment Schemes Act. Because Finance Act number 2 also makes it mandatory for REITs to be listed, it then means the Securities and Exchange Act also becomes part of the legal provisions, because you then have to be listed on an exchange that is established under the Securities and Exchange Act. And there are also amendments that were done to ensure that REITs become permissible securities under the Securities Act, because previously the definition of securities was just limited to your equities, your bonds, your derivatives, but not have REITs or units issued by REITs as securities. But now we have got this governing law. It means we have got the basis to actually go on and establish REITs in our market. So in terms, I'm skipping a bit of flesh because Mr. Mavingire, who is going to come later on, is going to go into detail in terms of the provisions of these areas. So bear with me, I'll just go on the top. In terms of setup, initial setup, and I'll just focus on pension funds. There's also setup for non-pension funds, but we'll not go into it. So for pension funds, basically, it's an easy process. You have to select an investment theme. So in this context, we are saying you could do a hybrid. You could do a focused theme. So let's say you want to focus on residential property. That becomes the theme that you are focusing on, or you are saying you want to focus on commercial, suburban properties, or you are focusing on industrial. That's the theme, because normally you find that investors want to understand before they invest, what is it that they're actually investing in. So some do mixed, some mixed use, some focus on particular themes, and that's quite key in terms of appeal to your target investors. The first part is you can actually register the REIT. You then go on to register the REIT scheme. So registering means you're actually coming up with a deed and the prospectus, which you then submit to the registrar or the Collective Investment Schemes Registrar, which is the Securities and Exchange Commission. They then register your trust, and once it's registered, you can then transfer existing properties to that REIT, which means you move your current real estate assets to the trust. So there's exchange of ownership there. Then you can then go on to list. Let me emphasize there that REITs can be established and you don't need to list them on the exchange. But if you don't list them, it then means there's no tax benefits or there's no tax exemption. So you can establish a REIT under the Collective Investment Schemes Act and just maintain it as a private REIT, not listed. The only disadvantage is that with that type of a REIT is that it doesn't get the tax exemption that makes it a bit more tax efficient if it's not listed. The other route would be to register the REIT scheme. Instead of transferring existing assets, you can actually then go on to acquire new assets under that REIT. So under that trust, it can then start acquiring its own assets, which are independent perhaps from the current assets, or it can actually go on to raise funds through the listing, which funds it can then use to either acquire or develop new assets. So those are the three different mechanisms by which you can actually establish a REIT as a pension fund. In terms of the listings requirements, so this is assuming the REIT has been set up, it has got its own assets. What's then the next step? The next step, and I'm saying this for you to then get the tax exemption, because this is a requirement under the Finance Act. You have to comply with sections 331 to 334 of the ZSC listings requirements, which are contained in Statutory Instrument 134 of 2019. That section talks of property unit trusts. And the requirements under that section is that the entity coming through to list as a REIT is obviously needs to meet the qualities of a property company, which means that it has to indicate that it is involved in the business of real estate, and that it is properly registered as a REIT with the registrar of the collective investment schemes, and also that there's been an independent valuation of the properties has been done to ascertain the values that it is bringing to the market. That's basically what is contained in that part. The other provisions of what you need to meet, we obviously then say you have to comply with the provisions that are stipulated in the Finance Act number 2. So the provisions of the Finance Act number 2, just in summary, is that the trust is to principally be engaged in the business of real estate, which means at least 80% of the business being done by that trust has to be real estate, and that the trust is also to commit to distributing at least 80% of its income to investors. So this is where it then separates a REIT from a normal property company. With normal property companies, we have two that are listed at the moment. You all know that they operate, earn income, get taxed, and then the profit after tax is what they can then distribute as dividends. But those dividends are not mandatory. They are at the discretion of the board of that company. If the board feels that it needs to retain 100% of the income and not distribute it, means there will be no dividends to investors. But with a REIT, there's a mandatory distribution of at least 80% of the income that the REIT has made. So this is one of the distinguishing factors. And then in terms of free float, for a REIT, it mimics the similar requirements for equity securities, which is a 30% free float. In other words, to say 30% of the units issued by the REIT have to be held by the public, unless a private placement has been done prior to listing, in which case then the free float, a minimum of 20% is then permissible. So we do understand that perhaps from a pension fund perspective, you may be coming in at 100% from the onset. Exemptions can be applied for to then gradually comply with these required free floats. The reason why we require these free floats is to ensure that there's also a secondary market for these securities. Otherwise, if it's 100% owned by a single entity, there may be difficulties in getting secondary market trading on the securities. Then we also look at the profit history of the property portfolio that you are bringing, but this is subject to where it's applicable. If it's a REIT that has only been newly established and hasn't operated, we then look at the performance of the sponsor. But this is something that is not also mandatory. It's subject to where it's applicable. In terms of the listing process, basically, we are saying the REIT would have been registered, and that's the biggest part. The next step after it has been registered, then we have got discussions with stock exchange. as for us to understand what you intend to do with your REIT. Once perhaps we have agreed that it's something that can be brought to the market, you can then go on to appoint professional advisors. So in terms of the professional advisors that are required, some of them are actually the ones that are presenting today: your financial advisor, your sponsor, your legal advisor, your reporting accountants. This is the core team that you'd need. And in respect of property, you also need that third-party property valuer as well to ascertain the valuations of the assets that are coming to the market. This core team will then work on the documents that are required for listing, basically your pre-listing statement, which is then the document that you actually submit for listing. So the core team then works on the listing documents. There'll be listing particulars that are required as well, just the identification documents of the entity, to ensure that we also know the client. And then they also facilitate the application. So the application is submitted through the sponsor. A sponsor is basically a broker or any other entity that has been registered as a sponsor with the stock exchange. Currently, we only have got stockbroking firms licensed or registered as sponsors on the market. So the purpose of the sponsor is to assist you in compliance with the ZSE listings requirements. So the application comes through the sponsor, and we review the application. It then goes to our listings committee, who has got, so it's a board committee which then grants or actually disapproves the listing application. Once the listing has been approved, you can then go on to do a public offer if there's need. If it's a listing by introduction, we skip the public offer. You then go on to actually listing by way of introduction, and we finalize it by way of a listing ceremony to just celebrate the listing. So this is a summary of the listing steps. But as your core team works on the listing, they'll obviously be interacting with a number of other participants. If there's another underwriting required, if you want to do an IPO, which means they then have to appoint an underwriter. If there's a public offer as well, they have to do some public shows. Some public marketing, even private marketing of the offer, so that it gets takers from potential investors. We'll move on to why we think REITs are particularly important, especially for pension funds. I think the key benefit that we see from where we sit is the liquidity that it brings to the pension fund industry. The other benefits are obviously the income, like we highlighted, that this comes with mandatory distribution or mandatory dividend. It means there's some minimum guaranteed income to investors. But of also importance is to the pension fund industry. It's also an alternative funding mechanism for growth in your property portfolios, because it brings with it the opportunity to actually raise funding from those sectors that previously might not have been able to actually contribute towards real estate and development. And you'll see why, I think, later on. And then obviously, lastly, for capital markets diversification, it's a product. We all know that property is a good asset in anyone's portfolio as a natural hedge against inflation and capital loss. So bringing such securities to the market also helps in terms of diversifying the product offerings. Focusing on the pension funds. So number one is obviously the tax efficiency in the structure. So you find that in other jurisdictions, Kenya, for example, the exemptions go beyond just the income tax. You also find that there's capital gains exemption, there's exemption from stamp duty, and when the entity itself actually acquires units in another REIT, there's exemption on the taxes. When the entity also acquires new assets like new buildings, it's also exempted from those transfer taxes. So it's where we are trying to go. At the moment in Zimbabwe, the only exemption that we've managed to get is the income tax exemption on the structure. But obviously, with time, I think as we prove to the fiscal authorities that it's a working structure, we can always lobby for additional incentives. But at the moment, the structure is exempt from income tax, which means that the potential returns to investors are also higher. And because the potential returns to investors are higher, it means for a pension fund that wants to raise, capital, it becomes a plus because it's easier to market such structure as opposed to the current structure, which is a property holding structure. If you market a REIT to potential investors because there's that tax exemption which magnifies their returns, it becomes a much more liked asset, and the potential to raise additional funding is also then enhanced, which ties into the second column there, where we are saying the potential tax savings actually attracts new investors to this asset class. And secondly, by listing it on the stock exchange, you can actually raise long-term capital, because you can issue these units to new investors, and you raise capital which you can then deploy either to refurbish the existing properties, or to actually acquire new land banks, or to actually build new projects from. And once you are listed, you can do a secondary market capital raising, like where you can do rights issues as well, which are also avenues for long-term capital raising. Then the liquidity is that properties, and I think we all know the disadvantages of properties, that it's not a very liquid asset compared to your other asset classes like money market and equities. It's naturally very difficult to just sell a building as is, but where it's then unitized into units, it's much easier to sell the units compared to sell the building. So this is where the liquidity comes from. So there's increased liquidity for both existing and new properties, because you are basically unitizing your real estate. By unitizing, you're saying you're breaking it down from one complex unit to smaller bits, whose price is probably low enough to allow even a smaller income investor to come in. And then secondly, besides the liquidity that is brought in by breaking down a big project into units, you also get the benefit of the liquidity in the secondary market, that when these units are also listed, they then trade on a daily basis. So there's a ready market for it. There's a proper price discovery on the exchange, and it very much enhances the liquidity of that structure. Okay, this is just an illustration of what we are trying to say there by saying liquidity. So I took this screenshot from a real estate website. There's a building there being sold in our own city of Harare, going for USD 6.5 million. And the comment at the bottom there, we are saying the potential buyers for this have to be millionaires. So it means probably Mr. Enemo Taruinga talking, probably some colleagues as well in there. We are out of this market by virtue of that price there. We can't afford it. It's only a product, or it's only the millionaires who can afford this product. So it eliminates a big number of potential investors because of that price. But it's just one building. But if you are to convert this building into a REIT, what then happens is you break down that 6.5 million into units. So assume the REIT is established, issues 6.5 million units. What it means is that each unit is now worth USD $1. And instead of selling the whole building as is, you're actually selling the units, each unit to $1. What it means is that you and I, who are unable to fork out 6.5 million, we can spare $10, we can spare $1 each, and all of a sudden we have become a new market for this seller. So the liquidity aspect is that the REITs open up your property portfolio to a potential market that was previously not going to be even looking at it because of the virtue of the size of the amounts required. But by unitizing, you have broken down that complex building into units which even a common man on the street can afford. And so when you are selling it, it's much easier because you've got a wider pool of potential investors that can qualify or that can afford to actually invest in that asset. That's essentially the basic advantage of a REIT. Continuing on with the benefits, like I was explaining previously, we are saying that listed units can be traded in the secondary market. That's why we emphasize that free float and the potential. I'm sure the market has been going up. The potential for capital gains as well as the higher dividend yield will also attract investors. So that means it becomes attractive to investors, and that's what you want, people that are interested in your units. Then the issuer, which is the pension fund in this case. At the moment, we understand that some pension funds are facing liquidity issues in actually meeting their, the obligations to beneficiaries. And it's not easy to fork out or to hand over a building to your beneficiaries to say, okay, I don't have cash, perhaps take over this complex. But with units, you can actually do that. Instead of issuing cash, you can actually issue units in lieu of cash to your beneficiaries. So you have got a building that you can't sell, but it's unitized, and beneficiaries can actually get the units as part of their benefits. So it saves you from having to look for cash. And you can raise additional capital, like we said, through issuance of additional units. So here we started with 6.5 million units, where you now need money to refurbish this building. You can issue an additional units. You just go to your unit holders in a meeting, agree on the number of units that you need to be issued, and if they share, the unit holders agree, those units are then sold to other investors. The money raised is then used to refurbish or to actually invest in other new projects. And then lastly, the units that are on the market can also be used to acquire new properties. So instead of actually issuing units and selling them for cash, then taking the cash to buy assets. Assume there's a landlord owning a big building, they can actually seed their building into the REIT, and in return they get units in the REIT. So your units then start acting as as liquid capital, as liquid cash, instead of you going to borrow from the banks to then fund projects or acquisitions. You can actually just issue new units to acquire new properties, and that's some of the advantage. And just to illustrate the tax benefits as well. And this was just to illustrate the direct impact of having a tax through or a pass-through entity, as opposed to the current structure where assets or listed assets are owned through a corporate structure. So corporates are taxed an effective rate of 24.72 if you add the AIDS levy there, the 3%. It's an effective tax rate of 24.7% there. Then there's a 10% withholding tax for dividends. Now we had not factored in the new taxes that have been announced, but this is just for illustration purposes. So assuming we have got a property company and a REIT, they all start, they are in the same business of leasing properties, and they all earn the same income, let's say 10 million, same property expenses and admin expenses, and they all earn a profit before tax of 3 million. With the corporate structure, you are then taxed at that 24.72%, so there's 741,000 there, which goes to ZIMRA. In a REIT, because it's a pass-through, there's no corporate tax or a trust income tax, so it's zero. The net income under the corporate is obviously then diminished or reduced by that tax. The REIT still has got its 3 million. Then in terms of dividends, you find that, like we're saying, dividends in a corporate environment are not mandatory. So they are the discretion. Normally, they don't exceed 30%. Normally, corporates want to maintain a minimum of 3 times cover on their dividend. But with the REIT, there's that mandatory 80% of the income is to be distributed. So find the REIT will declare 2.4 million dividend, the corporate only a 30%, which is 677,000, and withholding tax on that dividend is applied on both sides. But you find that the net dividend to the REIT investors is about 2.16 million, and to the corporate it's only about a quarter of that. And this is what we're saying. This is what then makes investors to be interested in investing in a REIT rather than looking at the current structure. Besides the dividends, investors are also attracted by the diversification. So because we've also said we are dominating equity at the moment, people want to have some other assets in their basket. They would want ETFs, they would want REITs, they would also want fixed income in there. So the diversification effects comes in. The regular income as well, because there's a mandatory dividend. They are guaranteed that if the REIT is profitable, they will get at least 80% of that profit will be income. So they are guaranteed of regular income. This is where the mimicking of a landlord then comes in, because you are getting almost all the rental as dividends. Then obviously the lower initial outlay, like when you gave that example of that building which is being sold for 6.5, the initial outlay for an investor in that building is 6.5, but in a REIT it's only $1. So it's an advantage. The liquidity which comes through secondary, which comes through on the listing, and then the price transparency, because the market helps price discovery. To emphasize on the market development, we have got 58 securities at the moment, largely equities, 55 equities, and 3 ETFs. And of those 55 equities, we only have got 2 property companies. We lost 2 companies through delistings over the last 2 years, and our real estate representation on the market is only 1% of the current market cap. So it's actually in our interest to try and diversify this basket as well, so that we have more of real estate on the market. Lastly, in terms of the incentives that we are offering, so for those that would register REITs and then list them on the exchange, we are going to waive the initial listing fees. That is for the first 2 REIT issuers that are going to come to the market. And just to give you a perspective, our current listing fees are 0.05% of the value of the issuer, up to a maximum of 25 million. So the potential saving there is $25 million in terms of the waiver on listing fees. Then if this REIT also comes and settlement is being done on the ZSC depository, there is a rebate which you are offering on the ZSC CSD of up to 30% of the CSD levy. So this rebate goes directly to the issuer. So for every value of trades, let's say $1 million that is traded on your units, we calculate the income that would have earned as a ZSC CSD, and 30% of that income actually pay back to the issuer as a rebate, and that will be for the next 3 years. I think this is the last of my slides. Moderator, I will stop here and get any questions, if there are any.
Thank you very much, Mr. Taruinga, for that presentation. We will now open to the floor for questions. I see we have hands up. Lakmo, let me just enable your mic so that you can ask. Please proceed, Lakmo. kindly unmute your microphone. Lakmo, if you could unmute your microphone from your end. I think Lakmo is having challenges unmuting his microphone from his end. But possibly, Mr. Taruinga, if you could just for the benefit of the participants, possibly some would want to know if there would be any effect on the stock exchange with respect to the recent pronouncements, the pronouncements over the weekend with regards to the ZSE. Just possibly an update if you are able to address that now.
Okay, Mr. Gumbo. Yeah, so there were two aspects, I think, that touched on this exchange. One was largely on the operations of our custodial model, which touches on our stockbrokers. I think those ones were clear on what the authorities wanted. I think it's more of just controls to prevent third-party flows of funds, which should be easy to implement. But obviously, we need to get the relevant statutory instruments to get further guidance. But I think those ones will be easy to implement. The other aspect was the tax, the capital gains tax. So I'm not a tax expert, but currently there's a 2% and a 1.5% capital gains withholding tax on the sales side of all securities listed on the exchange. There wasn't really a capital gains tax in my own understanding, because with that CGWT, we had the withholding tax of up to 2% depending on when you sell. The announcement then says there is going to be capital gains tax. My understanding of the capital gains tax that it applies on the gain, and they're saying it will be up to 40% if you sell within less than 270 days, or it will be 20% if you sell after 270 days. Again, changes to tax also require amendments to the Tax Act, and probably a statutory instrument will then have to be issued to make it legal. So for now, that's our understanding. But in terms of how it's going to be implemented, we are actually trying to engage. In fact, my boss, Mr. Bgoni, could not be part of this meeting because he's got a meeting with our regulator, the Securities and Exchange Commission. They're actually in the meeting at the moment, and we are trying to see how we can actually engage the tax authorities with regards to the issue of the tax. So I think that's the summary. The other operational ones in terms of the money flows, I think that has been standard practice. That third party, they could be abused. So it's just a matter of giving guidelines to our members that this will be illegal. I think from a certain date. The tax aspect, I would say, probably give us time to consult, I think, the authorities to try and understand, because currently there's a capital gains withholding tax and there was no CGT, so we are still yet to get clarity on the issue of the tax.
Thank you very much, Mr. Taruinga. Are there any other questions? There is a request for you, Mr. Taruinga, to reshare the slide on the requirements.
Okay, noted. Let me do that.
Then meanwhile, the question on the chat platform is, it says, thank you for the presentation. Does the trading of units on the secondary market have an impact on the valuation of the property? In other words, do you foresee a scenario where the secondary trading? We are now having feedback from your end, Mr. Taruinga.
Okay, I hope my mic is not muted. So I'll start with the issue of the impact on valuation. So for any listed entity, there's what we call a market value and what we call an intrinsic value. The intrinsic value is what your financial advisor will give you. That is, they will use their calculators, use their assumptions, and then say, for example, for Delta, after we factored in these assumptions, we think Delta should be worth this much. That's your intrinsic value. Then the market value is the price which the market assigns. So Delta at the moment has got a market price of 400 odd per share. Multiply that by the number of shares issued by Delta, that will give you the market value. So for the REITs, they will also have the same synonym aspect. They will have a market value, but the market value may be different from the intrinsic value. I'll give you examples of the ETFs that we have got. At the moment, they are trading at a premium, a significant premium to the intrinsic value, which is the NAV. All the three, I think, ETFs are trading at a premium. So the market is valuing them more than the assets which are in these ETFs. So it's also possible that with the REITs, they could be traded at a premium or they could be traded at a discount, depending on what the market feels. So to answer you, I would say the market will assign a market value, but there's also the intrinsic value, which that's why the independent valuer will then use the metrics which are used to value property or rentals going forward, the expected interest rates, etc., to then come up with the value, the comparatives as well. So, but the market will definitely assign a value to the REIT, but there's also the intrinsic value which you get from your property valuers. But definitely, yes, the market will assign a value. It could be a premium, it could be at par, it could be at a discount to the intrinsic value. But it's not different from any other entity. At the moment, we have got the market values for Delta, but when it comes to transactions, you find that for any transactions, be it an acquisition and disposal, evaluation is actually then done to try and get the intrinsic value. And people normally use both the market and the intrinsic value to come up with a decision. Then I've reshared. I think this is the slide. I'm not sure whether this is the correct slide on the requirements.
Yeah. Thank you very much. I'll allow Mr. Bunu to come in. Are you able to unmute your microphone? Mr. Bunu? Okay, I will allow Mr. Ngunga.
Okay, thank you very much, moderator. Maybe to any more, the next slide where you are showing some flow chart of some sort.
It should be this one.
Yes.
Okay.
Maybe expand on the issue of the appointment of professional advisors. In this, in my question is, if say the entity has its own advisors on board, does it need to follow this route of appointment of professional advisors?
Okay, so they are what you call it, the requirements from both the SEC and the ZSC. There is some degree of independence that is required on certain advisors. So I'll give you an example. When you are registering the REIT, for example, the two principal advisors that are required is the manager, what they call the REIT manager, and the trustee. The manager and the trustee have to be independent. They can't be from the same entity. Then when it comes to listing, the sponsor is actually mandatory and is someone that has to be given the sponsor rights by the stock exchange. So you'll be forced to select from the list of 20 sponsors that we have at the moment. And my assumption, there may be this sponsor, unfortunately, there's no need for it to be independent. It can be from the same company as the one doing the REIT. There's no harm. But the manager and the trustee, as far as the registration of the REIT is concerned, they have to be independent. Then when it comes to valuation, you can't use someone who is not independent. There has to be an independent valuation of the properties. So it means you can't use in-house services for that. We'll have to procure these from someone, an arm's length transaction, so to say, outside of your influence. Auditors as well, you'll have to appoint auditors, and normally auditors have to be independent from the entity. But you can do your valuation, which you can compare with the financial advisor. The financial advisor may be in the same stable. We are not really hard and fast, but they can't do the valuation. They can advise you on other aspects, but they won't be able to do the valuation. The valuation of the assets has to be done by an independent property valuer. I hope I've answered you. So there are some services that can be done in-house, but there are some aspects that have to be done by independent parties.
Thank you, Mr. Ruinga. Another question, I suppose, which will be our last question for this segment before we go to the next presentation, is if one wants to reinvest their dividend on a REIT, will it be exempt from taxes?
Not necessarily. So you see that government has forgone the income tax so that they also get a bit of the withholding tax on the dividend. So they are saying we are not going to tax this dividend as long as it's being held by the corporate. We'll tax it in the hands of the investors. So you will not avoid the withholding tax because you want to reinvest it. The withholding tax will still apply.
Okay, thank you very much, Mr. Ruinga. I think that brings us to the end of the question and answer segment for this particular presentation. So we will now proceed to the next presentation, which is the REIT types. And to take us through that presentation is Mr. Mike Juru. Mr. Juru is the Chief Executive Officer for Integrated Properties, past President, Real Estate Institute of Zimbabwe, past Councillor, Valuers Council of Zimbabwe, and a practicing property valuer, estate agent, and real estate developer with 25 years industry experience. He is a passionate advocate for REITs. Mr. Juru, the floor is yours.
Good morning, everybody. To our hosts, good morning, Commissioner, the presenters, and the pension fund trustees who are here with us today. I give a total task today to be presenting to you the various models that are available. And I also wish to point that Mr. Tarunga did a good job in taking half of my presentation. The topics are related. I acknowledge that they are related, and it's listed to be a reinforcing point. What he has said, and if I have to be saying it again, we'll be trying to reinforce a point. On that note, I move straight into my presentation, which will go like the brief background, which has been shared already. The categories available, the operationalization of the Real Estate Investment Trust, way forward, and questions. It will be a very short presentation, and I hope we'll take note of the key issues and how we can proceed as pension funds to take advantage of the Real Estate Investment Trust.
Sorry, Mr. Juru, are you able to share your presentation on the screen?
Yeah, I thought I was sharing.
No, it's not showing
okay.
on my screen.
Okay, that's okay. Let me try once again.
Ms. Matesano, confirm from your end, can you see the presentation? Maybe it's just my end.
There's nothing, Mr. Gumbo. It's
Okay,
not. It's not showing.
Thank you, Commissioner.
Is it sharing now?
Not yet. Whilst Mr. Juru is sharing his presentation, just to advise the participants that we are going to be uploading the presentations on our website. I will be sharing the link to the presentation tab. So if you check later in the day, you will be able to access all the presentations. Thank you. You are sharing your race. Now we can see it.
Can you see it?
Yes, we can see it now. Thank you.
Thank you. Apologies for that. Technology times gets better of us, the aged. I'd shared that, right. The background is largely been shared that REITs originated in the USA, and their challenges that they needed addressed to allow other investors access to real estate investments. And us as Zimbabwe, we have our own unique challenges that we have that we also need the REITs to be addressing. And hence, taking from what was solved in America, that it will solve for us in Zimbabwe as well, that REITs will provide a solution of pulling funds from investors for purchasing and developing or financing a property. We all take note of our current situation with pension funds, with the contributions depending here and there, and yes, with the desire to still be playing a significant part in the real estate sector. That REITs, they come in where pension funds can come in together to be pull their funds to invest in real estate and realize the benefits, taking note of the huge benefits that come out of property investments. Your hedge against inflation, your returns coming from the rentals, and also above that, we are in an inflationary environment. We need that to be, we need pensioners to be cautioned, hence the route to invest in properties. Right. There are various categories, but broadly speaking, we have equity REITs. The REITs, they fall into two categories: the equity REITs and mortgage REITs, which are based on the type of investment that are made and the nature of the revenues. Let's take note the nature of the revenues. Beyond that, we have a category of hybrid, which is a combination of the equity mortgages, equity REITs and mortgage REITs. We also have the development REITs, and I'll be explaining more as I progress with my presentation. The equity REITs derive from they derive majority of their revenues from the rents paid by the tenants, according to the terms of the leases that exist between the REIT and its tenants. And if you now look at the mortgage REITs lends money to the real estate owners and developers directly by issuing mortgages or directly by acquiring existing loans or mortgages-backed securities. Their revenues derive from interest received on the bonds, on the loans of investment in the real estate instruments. Mortgage REITs are analogous to banks that lend almost exclusively to developers and lenders, except that they do not have customer deposits from which to lend. So you find in this case for pension fund that they are participating, they are taking over the role of the banks formally, and where if there's a feeling of being shortchanged along the way with the banks, it's not entirely taking over, but we are still attracting the funds, pulling them together, and then making them available. The mortgage rate's major advantage to the pension fund is that they you are guaranteed of your payments. If somebody defaults, they still have to be paying the arrears. So you can actually plan going forward. Rentals, if you go the IPEC-REITS, which deals with the rentals, the challenge that you may find along the way is that you can have voids. But whereas for mortgage, for mortgage REIT, you are guaranteed of getting the money. If somebody defaults, you repossess the property, you are reissuing it to the next person. I always jokingly said this about the bankers, that when they manage their risk, the benefit comes actually in people defaulting, then you are restarting, taking over the property. Yes, administratively cumbersome, but hey, be that as it may, people need to honor their pledges. Pension funds, you have a commitment to your pensioners to be given in the monthly pensions, and that clearly comes out with a mortgage rate where you are guaranteed. Then people just have to service their bond, their mortgages plus interest, and the amounts, unfortunately, they are then consistent throughout the period of where they will be holding the bond, and negotiations may be put in place for US dollar mortgages. We take note that the Reserve Bank has approved several organizations to be giving that, which pension funds may also need to take advantage of, develop their properties, and then issue mortgages, US dollar based mortgages, and the repayments just go straight to the pensioners. Now, the funds that are raised for mortgage rates, they are basically for the capital raises by issuing debt and equity in the financial capital markets, which the pension funds can participate in. In a nutshell, what I've just said is that, when you talk of the IPEC rate, which is the income of rental, the REIT owns and manages income-generating real estate for the benefit of its investors, therefore providing both liquidity and a stable income stream. Distribution to investors are underpinned by the leases I've mentioned that, and then income returns are generally predictable in as far as the rentals and the leases are concerned. I go to the extreme end. We are talking the mortgages, which I've just shared with you. They invest in mortgage REITs, invest in mortgages and mortgage-backed securities and related assets and generate revenue through income interest. Take note the difference. IPEC rate is about the rentals. Mortgage rate is about the interest. So depending on the level of interest that is chargeable, it determines the repayment. But the issue, the investors are exposed to the credit risk. I've talked about the credit risk. If you talk about a mortgage, if somebody defaults, you repossess the property, you are restarting the process. Whatever has been paid, it is sunk. So people are aware. People should make every effort to be servicing their bonds, which, in my view, the pension funds benefit a lot. A development rate is whereby a development or construction real estate trust involved in the development or construction projects for housing, commercial, and other real estate. Now, if you talk of a D rate, the issue is about you need capital growth, which you get from property. Yes, you have your land, you service it. Your cost of buying the land will be $10, servicing will be, say, another $10, but when you sell it will be $30. So you're looking at that capital growth, capital appreciation that comes in with developing. So you naturally have to develop at a profit. So where you intend to grow your investor funds, your pensioner contributions, the issue is about going for the development rates where you then have that growth, which will make the fund managers look good in the eyes of the pension funds, and ultimately the pensioners benefit from that. Now, there are various sectors where we can have the REITs. You can choose to go residential apartments or office parks, multi-story, etc. The retail, health sector. About the health sector REITs, one interesting one is that I think Zimbabwe, in Harare, we have about 4 retirement homes, and we have more people now who are aging with the capacity. So that's a huge market that honestly pension funds can actually be going into. And if everything is US dollar based, there's an appetite for such investment. The market is thirsty. Then talk about the infrastructure or road concessions. These are now much bigger projects, which ordinarily, if you look at other countries, the road constructions, the bigger projects that happen in most countries, they come from the pension funds. And for us in Zimbabwe, we have a huge opportunity with our infrastructure where it is. We are talking of currently what is now outstanding is the Harare-Chirundu road, and with the tolling and all, pension funds, they can play a part and bring their funds, pull their funds together, participate, and the amount of money is in perpetuity, which also is a expectation from the pension funds. The pensioners rather will be benefiting from that. Now, we have also have REITs that are diversified, which is a mix of the above. Then the development REITs I've talked about, which is basically about construction. Now, Mr. Taringa earlier on spoke about South Africa. Yes, there are various REITs that are listed in South Africa and also Kenya, Nigeria, Ghana, right? They do have, in Kenya, there are many residential. In South Africa, you have your office and your retail. Your sector, mainly in the first world. But I'm saying that these are opportunities. Infrastructure, again, in the first world, in USA, they have such. And we have an opportunity in Zimbabwe to be riding on that and filling in the gap, making our pensioners benefit from the REITs. Now, how do you operationalize the REITs? The REITs station has been talked about by Mr. Taringa, but yes, it's related to what I'm going to be talking about. Once you register your REIT, you'll have made a choice that what problem are you trying to solve? Is it about raising funds? Yes, you then attract the investors who come in and join the party. And when you have the funds, what are you doing? Are you developing property? So what starts off when you're raising funds appears to be an equity REIT. When you have to be developing properties, now the game changes. This is now about it's now a D REIT. And why we have to mention the D REIT is that because of the skill set that is now required. You now require a project manager, you need engineers and what have you. Already those services were being incorporated in your developments, but in this case, because of the transparency that is required, these now have to be declared, and as they're in the interest of the investors for their security. When you develop the properties, there are three options that would happen. You develop properties, you then offer mortgages. Suppose you're developing residential stands or building apartments, you then offer mortgages, and then beyond that, the dividends that will be coming out of the repayments. Or you can sell the properties. Again, the distribution, 80% of the income has to be going back to the investors. That would be a choice. Lastly, you can then be developing property that you can rent. From a D rate, it moves to an equity rate. So the roadmap upfront is required on how you are going to be pulling the funds together, what you're going to do with the money, and how ultimately the dividends will be distributed. You can raise capital, buy existing properties, and then rent the properties. Then you have your you pass out the dividends. Now, pension funds, this is an opportunity that is available only to pension funds where you register your REIT and then you transfer properties into the REIT. This is only available to pension funds, so something that you can take advantage of. And when you pull when the current properties that you have, I'm sure the regulators, when they did that, it was to avoid people wanting to sell their properties to REITs, because pension funds, they're known to require properties as part of their portfolio. Is a part of their portfolio mix, so there will be no reason to be selling. But if you have to be doing that, we are looking at various pension funds even pulling their properties together so that they are managed jointly, and then you enjoy the benefits that are available for real estate investment trust. Now, here is a simplified model that is the landowner or the property owner who sits into a REIT, where you have also institutional investors or individual investors that are coming into the REIT with a requirement of the listing regulations, where you need a fund manager. Is it a Security Exchange Commission? They require you to be a fund manager or asset managers. And depending with the type of project that you are going to have, I've mentioned the skill set that is required when you have to be developing the property or renovating the property. You need a project manager and the relevant professionals to develop your stands or to develop the units that you are developing. Beyond that, if you develop, you may then sell the stand, and you now need another skill set of estate agents. You sell the stands and you distribute accordingly. Or lastly, you can go through a mortgage administrator, issue the bond, then the monthly repayments, they come. You see the green lines which are flowing down, how things flow down, and then the brown line that is going up, which shows how the distribution of the dividends will be done. And further to explain that again, we still have the same model, but where you can, as pension fund, you can have to attract more funds from other pension funds. You can have the development reach that, or getting the prescribed asset status, which is done through IPEC. I'm sure you know the procedure on that, or IPEC will share at some point. Then you list your development rates, develop your stands or develop your properties. Now you choose to withhold the stands, then develop houses. That's value addition and capital growth. You sell the houses ultimately, then you offer your mortgage. You offer your mortgages to the beneficiaries. You get your dividend. Or if you develop just up to the stands, you again offer mortgages on the stands, and then you offer. You then get your dividend as the pension fund. Now, this is the standard model that is always discussed and shown, where you have the unit holders who are the investors, you have your REIT, you have the main sponsor or the pension funds which will have triggered the REIT. You have your fund manager who will get a management fee. You have your property manager, again, they get the property management fee, they manage the properties and be depositing the money into the REIT, which will then be distributing. And it has been discussed that you have trustees who play a part on the REIT. Right. The way forward, the last part of the presentation, is let's embrace REITs, Real Estate Investment Trust. They have the advantages, the tax advantages they've been talked about. They also have, it's a mechanism where you can then manage your properties for less. I would choose to say that you actually manage your properties for less by having a REIT with the set structure where you have various people that are involved, various professionals. They are regulators that are monitoring. So it's not only you who is looking at whatever is happening. You have more stakeholders that are involved in the operation of the REIT. ZSE, they'll be playing their part also to be seeing that things are done correctly, and they have their checklist. Unlike independently trying to run things on your own. And remember, we are talking about the pensioners here who need to be protected. And us taking the REIT route, which is the advantages that have been noted, over and above, if you get another regulator to be assuring the pensioners, because come end of day, there could be some mistrust between the pension funds and the pensioners. And us having a REIT, it gives them the assurance that yes, they have more police who are watching and their rights and interests are protected. Otherwise, on that note, and on the short presentation, I hope I have articulated on the types of REITs that are available, your mortgage REIT, your equity REIT, your development REIT, which you can then transform in the sectors that you can actually participate in to realize the benefit to the pensioners. Thank you very much.
Thank you very much, Mr. Juru, for your presentation. Indeed, we can see the passion in the way you speak about REITs. So we'll now open up for questions from the floor. If you need a clarification or you need to ask, please proceed to ask, or if you need clarification, you can do likewise. Any questions? One moment, Mr. Jakaza, let me just enable your mic. You can unmute and proceed with your question, Mr. Jakaza.
Okay, thanks very much, Mr. Juru. My question is on valuation. You understand that we have got a multi-currency system in Zimbabwe. Do you hear me?
Yes.
Yes, we can hear you.
Yes, we have got a multi-currency in Zimbabwe. Whilst this value was the value in RTGS, and maybe the value in USD, they converted official rate. That valuation in terms of now we are going to list this on the exchange. When it was in-house, we know that maybe if the valuation was not done properly, we would have our value. But now we are going to list it maybe 30%, 40% outside. If valuation is not done properly, it means that we will be selling our property at a song. How are you going to guard against that to make sure that when you are going to list, the price discovery is going to be fair to the pensioners? Thank you.
Thank you very much. Your question well noted. One of the biggest challenges that we have is what instructions are we giving to the valuer? The valuer, if you just say do a valuation, they'll go ahead and do the valuation. One of the things that you have to specify when you're issuing the instruction is the currency, the date of the valuation. And is the final, if you have to choose to say value in US dollars, and naturally when you have to, if you are getting your number in US dollars, suppose the property is valued at 300,000, this for argument's sake, in US dollars. Now, an auditor sees that the natural inclination is to then convert it to the official rate. So is it really the valuer who is doing that? I would not think so. But then for you to upload the figures in your financials, they are then using the official rate because they have a valuation that in US dollars. Whereas if you have to ask for a valuation to be done in ZWL, the number is then given independently as a US dollar valuation. Looking at the circumstances. Remember, if you look at the definition of a market value, you are looking at a knowledgeable buyer and a knowledgeable seller. There's nowhere on this planet that you would accept a number that you know it's low, or even the seller would the seller would not accept. We know the numbers. So it's about you getting a valuation in US dollars, and then for your accounting purposes, you're now converting it to official rate. Instruction to the valuer should be give me a value as at this date using the ZWL, so that it is a ZWL valuation from the word go. I submit.
Noted.
Thank you very much, Mr. Juru. One moment, Mr. Ngunga, you can proceed. You can unmute your microphone.
Thank you very much, moderator, and thank you very much, Mike, for the presentation. Mike, if you may go to the slide where you were showing institutional investors, etc. The previous one, I think, yeah. So I'm just looking at this flow chart and making a submission to the regulator, to saying, stemming back to the issue of the Commission of Inquiry findings on the loss of value, etc., where government or the state was has a portion of the loss of value, and them being also the largest land owners. Can such a platform of REITs be used where government seeds the land, and then institutional investors, including pension funds, can then be part of the REIT, and it's also listed, and the benefits are then accrued to the members who lost value? Is this something that can be proposed to government? And if so, can we as an industry start looking at it as an option to compensate for the loss of value? Thank you.
I think also the regulator will have to come in, but from where I stand as a practitioner in the field and my knowledge of what is currently happening, the Ministry of National Housing has a mandate to be delivering houses. And the Ministry of National Housing, in liaison with Ministry of Local Government, they are saying that they've land that is available. And what is the nominal fee of $4 per square meter for the land? It would be a huge proposal if pension funds could come in together. It's something at the back of my mind, it's something that is doable. The government has a role to play. The government is saying that we can put in the land. Pension funds are saying that we have the money to do that. And then it's about pulling together these different stakeholders, the government and the pension funds, put them together with the idea and then proceeding with it. At the back of my mind is something that is very practical and doable in view of the government's thrust, also with the mandate, the national housing, to be developing houses to address the housing backlog, to also the government, on the government part, which is Ministry of Finance, to address the losses that have happened. So we have Ministry of Finance, local government, national housing, and the pension funds. And in the equation, you cannot rule out integrated properties coming in to be putting the things together. That's just a joke. But anyway, you just need the professionals. This can be done at the back of our mind, and with what is currently on the ground, what is happening, feasible and practical.
Thank you very much, Mr. Juru. Are there any more questions? I don't see any hand or questions on the chat platform. So before we proceed to the next presentation, we will take a short break, about 10 minutes, and then we come back and proceed with our presentations. Let's take a 10-minute break and then come back for the last two presentations. Thank you very much. It is now 11:15. Welcome back to the Real Estate Investment Trust Masterclass, jointly organized by the Insurance and Pensions Commission and the Zimbabwe Stock Exchange. We will now proceed with our presentations, and to take us through the next presentation on setting up and listing a REIT is Mr. Welcome Mavingire. Mr. Mavingire is the managing consultant of Interlego Investment Consultants Private Limited, which is an investment advisory firm focused on providing investment solutions to institutional investors. He boasts over 20 years experience in financial services, and prior to co-founding Interlego in 2013, he had spent over a decade as an investment analyst and fund manager. Mr. Mavingire is a CFA, a charter holder, and is the immediate past president of the Investment Professionals Association of Zimbabwe. He's an associate member with the Chartered Governance and Accountants Institute in Zimbabwe, formerly Institute of Chartered Secretaries and Administrators. Mr. Mavingire, the floor is yours. You can proceed, Mr. Mavingire.
Oh, thank you very much. Yes, okay. Good morning, members. I'm just trying to, if you could allow me to share my screen.
It's all right. Thank you.
All right. Okay, I don't know why I'm struggling to share. Okay, my apologies. If you can just give me a few minutes to just sort out the technology issue.
It's all right. Thank you.
I don't know if you can see my screen now.
Confirmed, we can see it.
Okay. No, thank you very much. Yes, okay. So thank you very much for this opportunity. And also thank you to the Zimbabwe Stock Exchange and IPEC for organizing this, which I think is a very important workshop, especially for the pensions industry, given that a number of them are quite exposed to the property sector. And instead of property playing the important role that it plays to a portfolio, being a stabilizer, and or for some, they are now seeing it almost as a case where they are now hamstrung with liquidity issues. And also, we actually think this development of REITs is a welcome development in the sense that it will try to resolve the key issues, almost like killing two birds with one stone, where you are still exposed to a property, but you then get around the constraints associated with it. So my presentation will be a bit brief. I will look at the rationale for setting up a REIT. Most of the issues have already been highlighted, so it will be more of emphasis in pointing out to some specific and the thinking around, especially the regulatory framework Then I'll also dwell a bit in terms of the exact steps on how to set up the REIT. So maybe just to step back a bit again to see why, especially as pension funds, there's always the preference for real estate as an asset class. It's not by mistake. I think there are always key attractions in real estate, especially as an inflation hedge. If you look at our inflationary environment, we have a history of high inflation to hyperinflation in Zimbabwe. So it's natural that you want to be investing in assets that help safeguard the value of pensions against inflation, because inflation is always the #1 enemy of any pension fund. So real estate plays a big part as an inflation hedge. And this comes mainly because it's a real asset, it's brick and mortar. So the values tend to then move in line with inflation. Of course, there are other asset classes that one might look at, like commodities as an inflation hedge. But real estate is the one that has been readily available to this market and well understood in the market. It also provides a stable source of income for some, especially where we are talking of commercial properties, which are built specifically for earning rental income from them. And normally it's a predictable source, especially where you have a stable tenant. The sources becomes also stable in terms of the income that you get. And this matches help match the liability profile of pension funds, because for a pension fund, you are paying predetermined liabilities, which to some extent are predictable. So you also need income that is predictable to match that. Then there's also the issue that property has limited volatility or downside risk, mainly because it's supported by real estate. And I always emphasize, we don't say there's no volatility in property, but it's limited, because there's always the misconception that it's risk-free. It's not necessarily, but if you then compare with other asset classes, say equities, it then tends to be a bit more stable than those other asset classes. And more importantly, in a portfolio where you have equities, you have money market investments, your property acts as a very good portfolio diversifier, because it's giving you a totally different exposure to different factors and to different income sources. So it acts as a good property diversifier. But at a national level, it's also a good, the greater good that even politicians will talk about, because it contributes to infrastructure development. And the fact that as pension funds, our members are ultimately beneficiaries of some of this infrastructure, it's always a good thing to be seen to be also investing in that kind of infrastructure. But having said that, there's always been limitations, especially when we are talking about direct property investments. And this, despite all those attractions, they've then resulted in either investors being skeptical about property investments or not being able to invest in it at all. So if you look at the issue around divisibility and the valuation of property, it's always a headache. A small pension fund can't just buy a property because of the amounts involved. I think Animo spoke earlier about especially at individual level, you need millionaires to be doing that. And there are only a few of us even on this platform. So, but it's not just the at individual level. Even pension funds, there are some smaller pension funds that are excluded from investing in this asset class because of that. And valuation is always an issue, because you are talking of huge assets where significant amounts are involved, and the valuation tend to be very subjective. Then the other big issue is to do with the liquidity of the property investments, because the fact that once you invest in property, it's not something that you can sell overnight when you want liquidity. And you can't also sell part of a property. If it's a building, you can't say, I'm selling the windows or one wing. It's also a process on its own. And this is also related to even the transaction costs related in terms of either you're buying or selling property. So these challenges then tends to discourage property investments. And this is where now your real estate investment trust comes in. I think my colleagues have already explained, and it's one of the ways where you then try to unlock the value in the property investments. And with this new legislation, we have, say, pension funds already invested in properties, but the issue is always to say, now, how do I unlock the value? Because the more you are invested in a big property, which probably is not performing because of some of those restrictions, all you now have is trapped value in there, and that value is not flowing through to your members as a pension fund. So there's always now the thinking to say, how do we unlock value? And there are various ways of trying to do it with its own challenging. You can try to remortgage or leverage that property. But in this country, our banks, they are not very big into mortgage lending, unlike in other countries. More so now with this suspension in bank lending, it's not always easy to just get the loans from banks. But also, one way you can look at it is to say, yes, I can do sectional title subdivide, but this is where the transaction cost comes in again. It becomes very expensive to do that, and it's not a guarantee that you have takers of those subdivided properties. So this leaves two options. Either you just unitize the property into smaller units to allow smaller investors to be buying smaller units in it. That way, it then enhances its tradability. And if you want to enhance it further, you then list it. But some would even list as a property owning company. I think Anymore earlier on highlighted, whilst that is a good way of trying to generate liquidity, but it has its own drawbacks, especially in the sense that it's not as tax efficient and the dividends are not as high as where you have REITs. So this is just leading to trying to give you the background and why you would then need to be looking at real investment trust, because it's seen globally as a way of trying to unlock value in property. And as mentioned earlier, it's not something new. It has been in existence in other markets, especially in the US for over 50 years now, and they've seen its effectiveness. So I want to go back again. I know this has been defined to say what is a REIT, but to just re-emphasize some of those characteristics to say, yes, it's something that is unitized. You can use it either you want to purchase an existing property, then unitize it, or you want to develop an existing property. And normally for it to be called a REIT, it's not something that you just call a property, now this is a REIT. There are some aspects that has to be attached to it, especially the licensing and regulation part of it, because this is what then protects any ordinary investor. It gives them confidence now that this collective arrangement that I'm getting into, it suddenly won't turn into maybe a pyramid scheme and you end up losing your hard-earned cash. So that licensing and regulation is always important. And added to that is the tax neutrality. That tax pass-through status becomes very important, because what you are saying is it's an investor that would have invested in property on their own, So your tax status shouldn't change whether you invest in property directly or through a REIT. So what this means is for a pension fund, the fact that a pension fund is tax exempt, that shouldn't change if we are investing through REITs. And again, to draw comparisons with the property companies, because it will be treated as a separate special purpose, or whether it's a special purpose vehicle or a company on its own, whatever income is generated from there is taxed as an entity. And when you then get your dividends, again, that's where your tax status comes in. But here, your tax status is not affected because this is just a pass-through arrangement. And in this country, the REITs are done through collective investment schemes, whereas in other countries, it can even be a company like in South Africa. But here, I think I'll explain just now in terms of how exactly is done, the mechanics around the setting up of it. But it's under the Collective Investment Schemes Act, and it's normally listed on a securities exchange. And in this country, they've also made it a requirement for you to enjoy the tax neutrality status. It has to be listed. In other instances, it might not be compulsory, but in our country, it has to be listed, and that's why the ZS is playing a big role in terms of facilitating this. So to just look at the regulatory framework that governs the setting up of REITs in Zimbabwe, I think there are 4 main pieces of legislation which have to be read together to give you the totality of how a REITs has to come into play. First, there is the Securities and Exchange Act, which give the Securities and Exchange Commission of Zimbabwe the power to regulate all investment activities, whether it's funds, intermediaries, stock exchanges, and all. And like I mentioned earlier, for it to have that weight, it has to be something regulated. So that's where we then derive the specific regulation from. Then the specific act that then deals with REITs is the Collective Investment Schemes Act, which is administered by SEC now. When this act was set up in 1998, it was mainly, of course, it allows for the registration of all investment vehicles, pooled investment vehicles, but it was focused mainly on unit trust funds, which were either money market unit trusts or equity unit trust funds. But when a new statutory instrument came in 2019, which was SI 240, it then amended the CIS Act to allow for introduction of new products, which included real estate investment trusts. So that then expanded the range in terms of the products that can be offered under the Act and being administered by SEC. Then again, what we had at that time was to then just say this is permissible. But the trick with the REITs and the biggest attraction has always been the tax exemption status. And this came through Finance Act number 2 of 2020, which was announced in the 2021 budget announcement. So this criteria now becomes very important because that's what will then allow the exemption of REITs from income tax. I think Enimo mentioned earlier on that for now, our REITs are only exempted from income tax. Yes, there could be moves later on to look at capital gains and other incentives, but we think for a start, and the fact that if you buy property today in a REIT, you don't necessarily expect to be selling it tomorrow. So we think by the time maybe any REITs are established, they now want to dispose properties, there would have been enough lobbying to then allow also for exemption of capital gains tax. But for now, it's just income tax. So what did the minister say in terms of for a REIT to qualify for that tax exemption? It has to satisfy a number of requirements, but the most important being one, it has to be licensed and registered under the Collective Investment Schemes Act. I think that goes without saying. Then also, which then becomes very important, I think, especially for pension funds, for every other entity, for them to to be allowed to that tax exemption as a REIT, the properties should be developed after the effective date of the statutory instrument, which was 1 January 2021. But pension funds were specifically exempted from this. So what it meant was, because remember, for the especially tax authority, the authorities, these REITs, it meant foregoing tax because they are no longer charging the entity taxation. So they then switched it around to also encourage new developments. But because pension funds, one, they were tax exempt anyway, but it was also a way of trying to promote, because I'm thinking even the authorities were very aware of the challenges that were facing pension funds that were invested in property, especially the issues around liquidity. So to then promote that, they would then have to allow existing properties that are owned by pension funds to be packaged into a REIT and listed on a stock exchange. And the other requirement now that then comes with it, again, this is now the give and take. Yes, they allowed you tax exemption, but for them to make sure that the income being generated, indeed, it's going to the beneficiaries, there's a stipulation that at least 80% of the taxable income. Okay, first it should be from real estate so that you don't have something, maybe property only contributing 10% of a certain company and you call it a REIT and you want to benefit from that. But also the other stipulation is that at least 80% of the net income should be distributed as dividends to the beneficiaries or to the unit holders. That way now, that's where your tax status would come in. Like again, like I said, if you're a pension fund, when you then get your dividend, because you're tax exempt anyway, you are not going to be taxed. But if it's an individual, you might have benefited from the REIT not being taxed, but in your hands, you still have to give Caesar what belongs to Caesar. Then the other stipulations, it's also to do with the shareholder spread. This was more or less in line with maybe it calls stock exchange requirements. I know for the ZSC, it's a minimum of 300 shareholders, but the minister said there has to be a minimum of 100 and not more than 50% should be in the hands of 5 or fewer individuals. I think this was just meant to make sure that it's well spread. But again, the key issue, especially for you as pension funds, they are also exempt from this requirement of having 5 or fewer individuals. So what it means is, as a pension fund, you can still own even 60% of the resultant REIT and have other and have it listed and have the other 40% maybe trading on the stock exchange and all. You then benefit from the price discovery, the liquidity. You can sell at any point you want and all that. So I think it's also something favorable to pension fund. And like you said, it has to be listed on a licensed stock exchange. But previously, we would just say listed on the Zimbabwe Stock Exchange, but now the laws allows for more stock exchanges, and even under the ZSC, the Zimbabwe Stock Exchange and the Victoria Falls Stock Exchange. So depending on your source of income, if the source of income from that REIT, say, is predominantly in United States dollars, and you are able to distribute that, you can then choose to have it listed on the VFX. But unfortunately, if it's just Zimbabwe dollars, you then have to choose between either Zimbabwe Stock Exchange or a financial securities stock exchange. But the key issue is that the units should be publicly traded. I think to just look in terms of how exactly you go about it, and I think this is what maybe for most pension funds, it might be holding a portfolio, a significant amount of properties, and to say exactly how do I go about it. This is just my own view in terms of how you can take in terms of the steps. Of course, there might be variations here and there depending on specific circumstances and all that. But generally, you have to look at, first you have to develop the concept. What exactly do you want to do? What sort of objectives? You have to identify the properties that have to be part of the REIT. Even that's where you even decide to say, what will be the sources of my income from this? Will I be able, which exchange will I be able to list on? And will I qualify for the requirements there? Maybe what would be the minimum size that I could list and all that. But ideally, you want to have someone who is hand holding you in terms of all this. So that's where you normally appoint your financial advisor. They can even help you in terms of the concept development, even having this approved through your board of trustees, because it's something that has to be robust and everyone, all the trustees buying into the concept and understanding what will be the end game after that. Then after that, once all the necessary approvals have been obtained and all internally, then you then look at the constitutive documents. By constitutive documents, we are talking mainly about the legal document that will form the REIT itself, because it's registered under the Collective Investment Schemes Act. And that one, that act would say, for you to have a collective investment scheme, you have to have two key parties, which Enimo mentioned earlier. You have to have a manager who should be a licensed investment manager, and a trustee who is again a licensed trustee in terms of SEC requirements. So you then have to, so the trust deed now is the document binding the two parties, and this defines, it's almost like the constitution. This is your constitution of the REIT. It defines who does what. It defines even the fees for the managers and the trustee, their responsibilities, their powers, the limitations to their powers, even broadly your investment policies, where you can invest, where you can't invest as a REIT. Because remember, this REIT, it might start with a few properties, but its life will extend beyond even the promoters would have set it up. So you have to then think way into the future to say, if we want to acquire more properties, what should be the criteria? If we want to dispose, you even think around what should be the objective of the particular REIT, because you don't want to just say it's an amalgamation of properties. It becomes difficult, especially where we come to the second, when you are now marketing, because investors ideally want to say, if we are investing in a specific, whether it's a company or a REIT, you want to be clear in terms of what are the key performance drivers, what is the theme around this particular company or a REIT. So, for instance, you can choose to then say, we have a REIT that focuses maybe in the hospitality sector, for instance, or even hospitals, it will be building hospitals and all that, or if it's commercial properties, you're a bit more specific about where you intend, or you can even advise in advance in terms of the intended asset allocation. That then helps the investors understand what you are trying to come up with. Then you then have your advisory team. I have put this after the drafting constitutive documents to just say the initial documents can be just drafts done by your advisors for discussion, but you can still just even interchange the two steps. It just depends on the specific circumstances. But like I said, the prerequisites will be the investment manager and the trustee. And the Act allows you to even register an investment manager for or even a trustee concurrently with the registration of any collective investment scheme. But it's always easier unless you have interest in terms of managing that particular REIT. It's always easier to just look at who are the already pre-existing registered asset managers and the trustees, then choose among those. Then there are also the other team of advisors required. It's not exhaustive, but you always need the legal advisors, tax advisors. I've put in here the stockbrokers, but these are mainly your sponsors who then handhold you to the stock exchange now, because they now make sure that you satisfy the listing requirements. And normally you also need transfer secretaries for that. Then once you have all these in place, you then look at applying now to SEC for licensing. After licensing, or even concurrently, you can even start doing maybe informal approaches and all that for engaging investors, and also for the securities exchange for listing. And the actual listing itself will only come after you have been licensed, because that's also, again, a prerequisite. But you find that you would have already worked on most of your prospectus that you submit for listing. It probably just need a few changes to then satisfy the requirement of the particular exchange, but you'd have already done the groundwork. Thank you very much. I'll take questions.
Thank you so much, Mr. Mawengire, for your presentation. I will now open the floor for questions or comments. Questions or comments? If we don't have any questions or comments, so we'll proceed with the presentation. With the next presentation, I think we'll then open up, possibly the participants will have more questions after the next presentation. To take us through the next topic on sponsor roles, we have Mr. Langton Nyatsanza from Ingenium. Mr. Nyatsanza is one of the co-founders of Ingenium Private Limited. He's a registered stockbroker, registered property negotiator, and a student member of the Real Estate Institute of Zimbabwe. He holds a Bachelor of Commerce degree with honors in finance and a master's degree in business administration degree, both from the National University of Science and Technology. He's a member of the African Institute of Financial Marketers, and he has over 20 years of stockbroking experience at the highest level and a wealth of specialist local knowledge and expertise. Mr. Nyatsanza, the floor is yours to take us through the next topic. Thank you.
Thank you, Lloyd. Good morning, everybody.
Good morning.
Right, I am going to share my slide with you, then we will begin our discussion.
That's precise. That's what is the question. There is a way they came up with X1s. For anyone.
Sorry, we are getting a feedback. I think, is that coming from your background, Mr. Nyatsanza?
I think it is. Just one moment.
Okay. Mr. Nyatsanza, you are sharing the wrong screen.
Okay, let me try and fix that.
So maybe you can minimize the Teams one.
Yes, right, there we go.
Yes, confirmed.
We are together now.
Yes, thank you.
Okay, so my task is just to describe the role of the sponsor. As the previous speaker has alluded, a REIT can be traded on an organized exchange, or it can be traded over the counter. Now, in the event that you want to trade or list your REIT on the Zimbabwe Stock Exchange, you need a sponsor. So the first port of call is just to understand what the sponsor is. So basically, a sponsor is a go-between who stands in the gap between the issuer or the person who's developing the REIT and the exchange. The sponsor also acts as the issuer's advocate. The sponsor is also the agent of the exchange. So if the exchange wanted to talk to the issuer, they will typically go through the sponsor. So as a go-between, we can be described as the intermediaries, mediator, intercessor, broker, negotiator, interceder. You can choose from that list of different descriptive names for the role that we play. So as a sponsor, we've got two distinct roles. The first one is to lead the trust to a listing. But once the REIT is listed, the obligations don't stop there. As a listed entity, you still have a set of rules you must adhere to. So you can engage somebody simply as a listing sponsor who will take you to listing, then engage a second person to maintain your listing, or you can use the same sponsor. It's really dependent on the skill set that you are looking for at that specific point in time. So what does the sponsor do? The sponsor authenticates submissions made by the REIT issuer. So for anything that they do send in, the sponsor must then declare that they are satisfied with the compliance of such documents. The sponsor also needs to, from time to time, defend the issuer with regards compliance issues. So the stock exchange may believe that you're not exactly compliant. When that is the case, they'll come to the sponsor and say, is your client compliant? Sponsor will then state why he deems the client compliant. Typically, such discussion will protect the REIT issuer from censure or sanction by the exchange. So it's always important to have somebody who stands in your corner and also ensures that you are complying with the listing requirements. The sponsor will also facilitate correspondence between the issuer and the ZSE, and where meetings are held between the issuer, who is the person who has issued the REIT, and their various advisors. Such minutes should be in common course submitted to the ZSE and added to your file. What that does is it acts in mitigation when something eventually goes wrong, where a company can prove that they've done all necessary steps and that if they are found in breach, it is an accidental breach as opposed to a deliberate breach of listing requirements. The sponsor is the one who submits all your documents to the stock exchange, whether it's during the listing process or when you're now listed and you're making announcements or giving updates to your unit holders. Such documents must be submitted to the exchange via the sponsor. What you'll find is the sponsor, when he receives that submission, will go through it, and if there are any errors or omissions against the rules, will advise the issuer to make amends before making a submission to the ZSE. So basically, the issuer ensures that the documents are correct and complete. Part of the sponsor's role is to uphold the integrity of the stock exchange. That integrity is upheld by making sure that you as the REIT issuer are complying with all the necessary rules and making the necessary disclosures so that the market remains as transparent and as organized as possible. Where we are speaking with regards to a listing, the sponsor will also vet your appointed professionals just to make sure that when submissions are made, the quality of such submissions is at the level required by the ZSE. So that, in a nutshell, would cover the role of the sponsor. It's expected that the sponsor would discharge these responsibilities with due care and skill. And as I alluded to, the sponsor will always scrutinize any submission to make sure that it meets the requirement of the stock exchange. What's important for you as a potential issuer or a potential listed entity is, are you choosing the right person to do the job? Typically, the ZSE will look at the skill set of the sponsor you have chosen when you write to them. And where certain skills are limited for your chosen sponsor, they will direct that they engage somebody with the required skills. In the event that is not possible, they'll actually direct you to use another sponsor for that specific transaction before reverting to your chosen sponsor. So for as long as somebody is on the list of approved sponsors at the stock exchange, you can expect that they're competent and they'll be able to deliver to the standard required. And also that the ZSE will always keep an eye to make sure that that standard is maintained. That, in a nutshell, is what the sponsor does. But maybe just to help us understand it in a less technical fashion, most of us have experienced or at least witnessed or heard about the manner in which betrothal happens in Zimbabwe. So when a person meets another person and they decide that they want to get married, they engage in a traditional process. This traditional process requires that the gentleman visit his in-laws' place, where issues of lobola will be discussed. Now, as the groom-to-be, you don't just walk into your in-laws compound and say, I'm here to marry your daughter. You actually need to find a go-between who will represent you and assist you in understanding the norms and cultures of the family in which you want to marry. So basically, that go-between or the mnyai or the sadombo or whatever name you give them is in actual fact the sponsor. He's a friend to both parties, so he paves the way and makes sure that the relationship before and after the marriage is a mutually beneficial one. So that, in a nutshell, is what the sponsor does. Thank you.
Thank you so much, Mr. Nyatsanza, for your presentation on the role of the sponsor. I'm sure the participants have a better appreciation of what or how they can work with the relevant stakeholders if they want to list REITs. Are there any questions to the two presenters or the previous presentations? Any questions or clarifications that you may have? Any questions? I seem not to see a hand or questions on the chat platform. So if we have no further questions, I will allow the presenters, all the presenters, if they're still here, to give maybe their final remarks or issues that they may want to bring to the attention of the participants, which they may have skipped or want to emphasize. I will start with any more? Hello, Mr. Tarubinga, do you have any area of emphasis? Okay, I note Mr. Tarubinga has just dashed to another meeting. Mr. Juru, Would you want to come in? Mr. Juru? Okay, I'll go to Mr. Maringire.
Okay, thanks, Lloyd. I think what I can just say, yes, this is REITs is a new thing in this market, so there's still a lot of learning that almost everyone is going through, and I guess that's why there's even been some delays in terms of new listings coming through. But I think it's especially what I've mentioned about the benefits to the pensions industry. I think it would be important for the industry to also take the initiative to promote this, because I think it's actually beneficial hugely to the pensions industry. And also for IPEC, I think there's need for serious consideration for according prescribed asset status for this kind of instruments, because they more or less tick the boxes, if I call it that way. It's benefiting not only the industry, but even the economy at large, especially where we are looking at infrastructure development. We think it's something that is beneficial to the economy. But for the pension funds themselves, they are also then able to kill two birds with one stone. They are complying with your asset allocation requirements, reducing concentration to one asset class if it's a pension fund already overexposed to property, but at the same time, you are also then complying with the prescribed asset requirements. I think that's all I wanted to say.
Thank you very much, Mr. Maringire. Mr. Nyatanza, is there anything that you would want to emphasize, even some of the issues that may have been touched on by previous speakers?
Yeah, I think maybe to echo Welcome's comments, while this is new, it's things that have happened elsewhere and have lent tremendously to real estate development and general development in other nations. And for us as a country, it's a way of unlocking what would be termed dead assets in this case. So my encouragement is to the members here present to embrace this initiative and maybe take it further so that we develop this asset class in a manner that benefits all the stakeholders. I think aside from the listing aspect, REITs can be traded over the counter. That being the case, liquidity comes in for the funds without incurring too many expenses. So I'd say go for it as an industry. We as advisors, as professionals, we are there to support.
Maybe while you are speaking, if you can stop sharing, you are sharing something on the screen.
Okay, thank you.
You can proceed.
Right. So I was just saying, for us as an industry, I think it's important to embrace this asset class because of the downstream benefits that it has for the nation and for us as stakeholders. Thank you.
Thank you very much, Mr. Nyatanza. Thank you, Mr. Maringire. If Mr. Juru is not back, I'll allow Ms. Matei-Sanwa to give us the vote of thanks, which will bring us to the end of our... Okay, Mr. Juru, I see you're in. You can proceed.
Yeah, thank you. What I would want to encourage members here present is not to think in silos. Let's look at our challenges and how we can solve them through the REITs. Let's also remove the silos that are built within, that appear before you start implementing this, where we are building walls in front of us and removing the walls, approaching this with an open mind, with the flexibility that is available as you transition from one model to the next, all to achieve your desired goal. Let's use the available models as a roadmap to achieve the desired end. And it is available, it is possible. It's just about us embracing what the opportunities that are presented before us with the REITs. It is happening all over the world, and we can do it. We can do it too. Just solving our problems through REITs. Thank you very much.
Thank you very much to all our presenters. I will now hand over to Ms. Matei-Sanwa for the vote of thanks.
Thank you, Mr. Gumbo, for steering the ship so well. Indeed, I think this has been a very fruitful workshop for all of us here, even us at IPEC, you know, the unpacking of this new investment class to all of us. So I would like to extend my gratitude once again to the Zimbabwe Stock Exchange, the whole team, Precious, Animal, and Mr. Boni, especially in absentia, for this wonderful gesture, Tapiwa. It has been a long journey, and we thank you for your positive cooperation, you know, putting through all the necessary arrangements so that this particular webinar could be a success. And also allow me to extend our gratitude once again to all the presenters, Mr. Majuru, Mr. Nyatanza, and Mr. Mavingire. Thank you for those insightful presentations. Indeed, we have learned a lot from your presentations, from the unpacking. I'm not forgetting any more again as a presenter. And I want to encourage the industry, just as the presenters have said, to embrace this new investment vehicle. I am sure all of us, we have appreciated the immense advantages that this new vehicle presents to our industry. And we need to take that step, you know, that step of action where we now say as a pensions industry, let us tap into this so that we can derive the benefits that can be derived from this for the good of our pension fund members. Like Welcome said, and like the commissioner previously highlighted, we acknowledge that properties, you know, they continue to be favorable and to our industry because of their inflation hedging characteristics. But we also need to derive maximum benefits from these investment vehicles. And from the presentations that have been shared today, I'm sure all of us are now wiser regarding how we can achieve this particular trust, not only liquidity. I was particularly, you know, intrigued by its ability to also raise, you know, capital to facilitate other investments. So let us tap into this and let us embrace it. Let us not shun, you know, from these new investment classes. That's why we have organized this particular workshop, for us to get that understanding. And we are hoping and looking forward as a commission that following this particular workshop, and especially for the particular funds that are here, given your exposure in property investments, that we are going to see our proposals and suggestions on how we are going to be utilizing this new vehicle. Back to you, Mr. Gumbo. Otherwise, thank you, everyone, and have a fruitful day, what's left, and all the best for those who will be traveling back to your various workstations. Thank you.
Thank you very much, Ms. Matei-Sanwa, for your closing remarks. Just to remind the participants that we will be uploading the presentations on our website. You can check the link which I sent on the chat platform, which is the presentations tab. That's where we are going to be uploading the presentations later in the day so that you can access them. And also to remind the participants, those who have not shared their proof of payments, if you could kindly do so, I would really appreciate. Thank you so much. Enjoy the rest of the day and the week, and continue to take care and be safe. Thank you. That brings us to the end of our meeting.
Thank you and goodbye.
In this time, things, you are commissioner.